Section 4, Exchange Rate Regimes. Every exchange rate is managed to some degree by central banks. The policy framework adopted by a central bank is called the exchange rate regime. Before we talk about the different exchange rate regimes, let's look at the properties of an ideal exchange rate regime. The curriculum talks about three major properties. The first one is that the exchange rate between any two currencies would be credibly fixed. In other words, if you have two currencies A and B, ideally there should be a fixed exchange rate between these two currencies that would avoid foreign exchange risk, and this should be credible. In other words, the counterparties should trust the fact that this exchange rate will hold. All currencies would be fully convertible. This is fairly obvious. You would want to convert any currency into any other currency very easily. And finally, each country would be able to undertake fully independent monetary policy. Clearly, these three represent an ideal scenario, but 1 and 3 cannot happen at the same time. So any currency regime would require some trade-off. And as we look at the spectrum of different regimes, that spectrum effectively involves some sort of a trade-off between the ideal scenario or the properties that we see over here. Section 4.2 in the curriculum talks about the historical perspective on currency regimes. This is not mentioned in the learning objectives, and I don't see any examples or practice problems on this either, but I think it is interesting, and for finance professionals it is useful to know the very brief history, and I will share that with you. For most of the 19th century and the early part of the 20th century, in fact up to 1943, the world largely operated on the gold standard. In other words, currencies such as the dollar and the pound were based on gold reserves. And then if other currencies were based on the dollar or the pound, then indirectly they were also based on the gold standard. Then in 1943, the Bretton Woods Agreement took place, where the gold standard was abandoned and major currencies moved into what can be roughly described as a fixed parity or fixed rate system. That lasted till about the early 1970s. With the fixed parity system, there were issues with countries not being able to exert their monetary policy independently. There were inflation problems and so on. And then after the 70s, most of the major economies moved towards a free float system. That's all I'll say at this stage. Now what we'll do is talk about the various exchange rate regimes, their similarities and differences, and that is what you are likely to be tested on. Here are the various regimes, and you will notice that these regimes span a spectrum. At one end of the spectrum, we will have rates which are fixed against another major currency such as the dollar or the euro, and at the other end of the spectrum, we'll have rates or exchange rates which are completely floating. Now let's start at this end of the spectrum. The extreme here is that a country does not have its own currency, no separate legal tender. And there are two ways that can happen. One is dollarization, where a country such as Panama says that we do not have our own currency, we will simply use the US dollar. So effectively, this country does not need to have a monetary policy of its own. It simply imports the currency and the monetary policy of the United States. Another scenario is a monetary union, and the classic example is the Eurozone, where countries in the Eurozone have adopted a single currency called the euro. Here the issue is that a country like Greece now, for example, which is part of the Eurozone, cannot print its own money, it cannot exert its independent monetary policy. Then we get into the currency board system, where the country has its own currency, but an explicit legislative commitment is made to exchange the domestic currency for a specified foreign currency at a fixed exchange rate. The classic example of this is the Hong Kong dollar, where there is a legislative commitment to maintain a certain exchange rate between the Hong Kong dollar and the US dollar. This commitment does allow for a very small band. So there will be a certain exchange rate and it will be allowed to fluctuate just a little bit around that rate. Key point though is that this is a legislative commitment, so it is very credible. The next one is fixed parity. So we are slowly moving from left to right on this spectrum. With fixed parity, a country pegs its currency with a band of approximately 1% versus another currency. But the difference between fixed parity and currency board is that with fixed parity, there is no legislative commitment. That's one difference. The other difference is that here, the level of foreign exchange reserves held by the country are discretionary. An example of a country which does this is Saudi Arabia. Next is target zone, which is like fixed parity but with wider bands. Here we had 1% bands. Here we typically have a plus minus 2% band, which gives the monetary authority a little more flexibility. Active and passive crawling peg. This is where the currency is pegged against another currency. So on the fixed to flexible spectrum, we are still closer to the fixed side, but moving towards more flexibility by saying that the peg can crawl. In other words, there is a peg, but that peg or exchange rate is allowed to slowly move in whatever direction is necessary. The exchange rate is adjusted frequently to keep pace with inflation, and when this happens, we say we have a passive crawl. At times, the monetary authority will pre-announce what the pegs will be for the upcoming days or weeks, and that is called an active crawl. This helps set expectations about exchange rates. The next level is fixed parity with crawling bands. In other words, we have the parity established, but the bands are flexible. This allows for a gradual exit strategy from fixed parity. And then we come closer towards the flexible system. Manage float, exchange rate policy based on either internal or external policy targets. Intervening or not, and this is the central bank, decides to intervene or not to achieve trade balance, price stability, or employment objectives. In other words, the central bank has certain policy targets and objectives, and it decides whether or not to interfere with exchange rates in order to meet its objectives. And finally, independently floating rates. Here the exchange rate is completely left to the market. The monetary authority is able to exercise independent monetary policy aimed at achieving such objectives as price stability and full employment. This, by the way, is also called a dirty float because the currency is floating but with some intervention, so it is not completely clean. Here I have reproduced Exhibit 8 from the curriculum. You don't really need to remember the facts over here, but I think it is interesting to know what types of regimes exist in different countries. I mentioned Ecuador or Panama earlier, so here we have dollarization, monetary union. This is the European Monetary Union or the Eurozone. These are the countries in the Eurozone, at least at this point in time. currency board, big examples are Hong Kong, which is tied to the dollar, and then we have some countries which are tied to the euro. These are examples of fixed parity against the dollar, fixed parity against the euro. And then here are some other well-known examples. Notice that outside the Eurozone, a lot of countries now follow the independent float system. Here are some excerpts from example 7, and I insist that you do this example because it will give you a sense for what you might see on the exam. And the small excerpt here is just to get you started. We have a client and her advisor who are discussing potential investments in Hong Kong, Panama, and Canada. Note that the question will tell you what sort of regime exists in what country. You are not expected to remember this information. We are told that Hong Kong has a currency board system, Panama has dollarization, and Canada has free float. And then let's look at these comments or these questions. Based solely on the exchange rate risk the client would face, what is the correct ranking from most to least risky of the following investment locations? And those are the 3 locations. From a exchange rate risk perspective, for a US based client, Canada would be the most risky because Canada follows a free float system. So the exchange rate between the Canadian dollar and the US dollar is likely to fluctuate more than the exchange rate between the US dollar and these currencies. So highest exchange rate risk over here, then Hong Kong, because Hong Kong has the currency board which is fixed but allows for very small deviations. Panama is dollarized, so there the currency is the dollar and we would have no exchange rate risk. So greatest risk with Canada and the least risk, in fact no risk, with Panama. Based solely on their foreign exchange regimes, which country is least likely to import inflation or deflation from the United States? This is also an important point. The country that will import the most inflation is the country that follows the US currency. So Panama uses dollars, so here there would be the most inflation. Hong Kong is practically pegged to the dollar, so inflation will be imported here also. Canada is on the free float regime, so Canada will exert its own policy, and Canada therefore is least likely to import inflation or deflation from the United States. True or false? A fixed parity regime means a constant exchange rate and is more credible than a currency board. This is false. Constant exchange rate, this is not exactly true. Even with a fixed parity system, we do have some bands, so it doesn't mean a constant exchange rate. More credible than a currency board, this is also false, because remember, with a currency board we have a legislative commitment, whereas with fixed parity we do not have a legislative commitment. We now come to the final section of this reading, which is exchange rates, international trade balance, and capital flows. The impact of exchange rates and other factors on the trade balance must be mirrored by their impact on capital flows. This is a very important and testable point, and possibly a source of confusion. So let me first just clarify some confusion between terminology used here and terminology used in the previous reading. What this reading is doing is taking capital flows and essentially covering both the capital account and the financial account that we discussed in the previous reading. So on your exam, when you see capital flows or capital account, you need to look at the answer options and determine from the context what exactly is meant by capital. In this context, the capital is essentially capital slash financial flows, and it covers both the capital account and the financial account from the previous reading. Roughly speaking, the trade balance is covered by the current account. Now, what this point is saying is that if we take a country perspective, which is the perspective that we take in this discussion on international trade, so this is a given country. If the country has a trade deficit, which means that exports are low and imports are high, the X minus M is negative, then this particular country must borrow from the rest of the world, either borrow from the rest of the world or the rest of the world must be buying assets in the country. In other words, money from the rest of the world or foreign exchange has to flow into the country in order to fund this trade deficit. These two numbers, the trade deficit and the capital inflow in this context, must be equal and opposite. The sort of questions that you will see in the curriculum will use the following terms. A trade deficit must be balanced by an offsetting capital surplus, or a trade surplus will be balanced by a capital deficit. So make sure that you understand this terminology, and when you practice a few questions, then you will be on top of this material. Another important testable point is that a trade surplus reflects an excess of domestic savings over investment spending. Here is the relationship that you need to remember. X minus M, or the trade surplus, is equal to private savings minus investment. So this is the savings that individuals or private entities do above the investments which are made in a given country. This is the business investments, plus T minus G. T is the revenue that the government gets, G is government spending. So this is actually government savings. If this is government savings, this is private savings, then effectively you can see that X minus M is based on the difference between overall savings and the investment number. If overall savings, both private and government, are very high relative to investments, that would mean that we will have a high trade surplus. If the savings are low relative to investments, then this number will be negative, which means that we have a trade deficit. In case you have trouble remembering this formula, here is what I suggest you do. Remember from an earlier reading in macroeconomics, we said that there has to be an equality between income and expenditure. Income must be equal to the total consumption plus savings plus taxes. That is the three places where income goes: consumption, savings, and taxes. This is equal to expenditure, and I'm sure you remember this, that expenditure is equal to the consumption plus investment plus government spending plus expenditure by the rest of the world, which is X minus M. From here you can easily see that C and C cancels out. Then X minus M is equal to S minus T plus T minus G. So note that this relationship can be easily derived as long as you remember the basic point that income must equal expenditure. There are several questions in the curriculum that test this concept, so make sure you are on top of this. And I think this is particularly testable because this concept shows up in several places, and make sure you are on top of this. Next point. Capital flows, both potential and actual, are the primary determinant of exchange rate movements in the short to intermediate term. And this is basic supply and demand. If the demand for a particular currency is high, possibly because the rest of the world wants the goods and services produced by this country, then the currency will strengthen. If the demand for the currency is weak, then the currency will weaken. The impact of the exchange rate on the trade balance can be examined using the elasticities approach and the absorption approach. The point here is that if the currency either appreciates or depreciates, what is the impact on the trade balance of a country? And that impact can be evaluated using these two approaches. These might seem a little bit complicated, but they connect very well with material that you have seen earlier, which is why I think this is important. In section 5.1, we will talk about the elasticities approach, and you will note that this approach is based on microeconomic concepts that you studied early in economics. Here you need to learn what is called the Marshall-Lerner condition. This condition describes the combinations of export and import demand elasticities such that depreciation of the domestic currency will move the trade balance towards a surplus. We can also say that the Marshall-Lerner condition describes combinations of export and import demand elasticities such that an appreciation of the domestic currency will move the trade balance towards a deficit. And this is the condition which I will explain. The W over here stands for the relative weight of exports. Wx is weight of exports. Wm is the weight of imports. This is the elasticity of exports and this is the elasticity of imports. If this condition holds, this condition being that expression being greater than 0, then a currency depreciation will reduce the trade deficit. So if the trade deficit, for example, is 200, which means that imports are more than exports. If this condition holds and the currency is depreciated or the currency depreciates, then the trade deficit will become less. Let us look at an example and then we will go back to this formula. This example is based on what is given in the curriculum. Let's say that our domestic country is Italy, which operates in euros, and Italy trades with the United States, which operates in dollars. Initially, Italy's exports are 400 million and Italy's imports are 600 million. Clearly, we have a trade deficit of 200 million and initially the total trade is 1 billion. We are also told that the demand elasticity for exports is 0.75 and the demand elasticity for imports is 0.65. And what do these numbers mean? A demand elasticity of 0.75 means that if prices go up by 1%, then the quantity demanded will come down by 0.75%. If we say that the domestic currency, here the euro, depreciates by 10%, so the euro is down by 10%, what will happen to exports? Clearly, for the trading partner, in this example the United States, Italian products will become cheaper because the currency euro is becoming less valuable compared to the dollar. So from a US perspective, Italian goods are now cheaper. In fact, we can say that from a US perspective, the price is actually down. If the price is down, then the quantity will be up. But by how much? If the price is down by 10%, then the quantity demanded will be up by 7.5%. If the original quantity of exports was 400 and now the price from a US perspective is down by 10%, the quantity will go up by 7.5% of 400,000, and that is 30 million. So exports up by 30 million. And this is 30 million euro. Remember, our calculations are being done from an Italian perspective, so that would be a euro perspective. Italy is still getting money in euro. America is buying more. From an American perspective, things are cheaper, so they are buying more. But from the export part of the trade, Italy is getting 30 million more, and that is reflected over here. Some students get confused about the fact that the price is not changing, and again I'll emphasize that is because as far as Italy is concerned, it is still getting euro. So if euro has devalued for the rest of the world, as far as Italy is concerned, 30 million euro is still 30 million euro. What about imports? Italy is importing 600 million worth of goods from the United States. When the currency weakens, what will happen to imports? And here there will be two impacts. Now, with the currency weakening, the price of the imports is obviously up. The price is up by 10%. In euro terms, the price is up by 10%, and the quantity will be down. Now, by how much does the quantity reduce? Given that the elasticity of imports is 0.65, this means that if the price goes up by 1%, the quantity will come down by 0.65%. If the price goes up by 10%, the quantity will come down by 6.5%. So here we have two impacts in opposite directions. In euro terms, the imports are more expensive by 10%, but the quantity is 6.5% less. The net impact is 10 minus 6.5, which is plus 3.5%. This means that in euro terms, the value of the imports is up by 3.5%. If the value of the imports initially was 600 billion, now the value of imports will be 3.5% more, which means 21 million. 21 million is 3.5% of 600 million. So overall, what is happening? The exports increased by 30 million. The import, again in euro terms, increased by 21 million. Note that here both numbers went up. Exports went up, imports went up, but exports went up by more than the imports, and the trade balance actually reduces by 9 million because exports went up 9 million more than imports. Therefore, the trade balance now is 9 million better. Initially, our trade balance was a deficit of 200 million. Now that deficit has been reduced by 9 million. Initially, the total trade was a billion. Now that total trade has increased by 51 million because both the imports and the exports have increased. Let us now come back to this Marshall-Lerner condition, and we'll see that this condition does indeed hold true. When you plug in the numbers, the weight of exports, that is equal to 0.4. Notice exports are 40% of the total initial trade, multiplied by the elasticity for exports, which is 0.75, plus the weight of imports, which is 0.6, into elasticity of imports, which is 0.65 minus 1, and this will give us 0.09, which is greater than 0. So the Marshall-Lerner condition does hold, and since this condition does hold, we have a reduction in the trade deficit because the currency went down in value. Let us also connect this point 0.09 now with this number over here. What does 0.09 mean? This means that a 1% decrease in value of the currency will improve the trade balance by 0.09%, which means that a 10% reduction in value of the currency will improve the trade balance by 0.9%. If you take 0.9% of our original trade balance, we will get 9 million. So that is the connection between this and the calculation that we have done. And I hope you recognize what is going on over here. Behind all this somewhat complicated looking calculation, the basic idea is straightforward. The impact on the trade surplus or deficit depends on the elasticities of the imports and exports. Clearly, if the elasticities are high, and these are the price elasticities, if the elasticity of imports and exports are high, then a change in value of the currency is going to have a large impact on the trade balance. On the other hand, if the imports and exports are not very price elastic, then changes in the price of the currency, which is the exchange rate, will not have much of an impact on the trade balance. On this slide, we will make a few more points related to the elasticities approach. As discussed on the previous slide, when a currency depreciates, the trade balance will reduce if the Marshall-Lerner condition holds. When we say that the Marshall-Lerner condition holds, we mean that this expression is greater than 0. Now, I just want you to understand the 4 different scenarios that can take place. And what we will do is look at the impact on X minus M. This is the trade surplus, or you can look at this as the negative deficit, but it's easier to think of X minus M. What is the impact on X minus M in 4 different scenarios? Now, what are those 4 scenarios? They are depicted in this 2x2 matrix over here. The vertical axis represents currency. This means currency going up, and the bottom part is currency going down. On the horizontal axis, we represent whether this expression is positive or negative. These 2 boxes over here represent situations where this expression is positive. So we can say that in these 2 boxes, the Marshall-Lerner condition holds, and in these 2 boxes on the right, the Marshall-Lerner condition does not hold. The scenario that we just saw was this box at the bottom left, because the currency devalued and the Marshall-Lerner condition did hold. In other words, this expression was positive. We were over here and X minus M went up, which means that if we have a deficit, so if this is X minus M, a deficit means we are somewhere over here. Let's say that this is 0, neither a deficit nor a surplus. When we are in this box, then the deficit becomes less. In other words, X minus M is increasing. What if the currency appreciates and the Marshall-Lerner condition does hold? Then X minus M will come down. On the right hand side, where the Marshall-Lerner condition does not hold, in other words, this expression is negative, then what will happen? A devaluation of the currency will actually cause X minus M to come down, and an appreciation of the currency will cause X minus M to go up. I have gone over this because when you do example 8, this information will come in handy. And if you can just understand this one, currency down, Marshall-Lerner holds, then X minus M goes up. From this, you can come up with the three other boxes very easily. The second point I want to make here is that the impact of a change in currency value depends on elasticities. And that is fairly obvious when you look at this expression. If the elasticity numbers are high, then this number, the overall number, will be more positive. And if you recall, on our previous slide, we had a certain number which was 0.09, which represented a change in X minus M when there is a 1% change in price being the exchange rate or the price of the currency. If this number is more positive, then the impact will be more. And I'll repeat, higher elasticities will make this number higher. So remember the fact that if the elasticity is more, the impact is more, and that is also fairly intuitive. The next question is, what do these elasticities depend on? And the answer is that elasticity depends on whether they are close substitutes or not, whether the goods being imported or exported are luxury goods, whether the goods represent a significant percentage of income or not. And I hope all this sounds familiar because this is exactly what we studied early on in microeconomics. And I think it is useful to see this particular approach because it builds on microeconomic fundamentals and it helps you revise what you need to know. The final point is that we might have a J-curve effect when there is a change in value of the currency. What that means is the following. We have a certain trade balance and let's say that the currency devalues. We might think that the trade balance will improve, X minus M will go up if the Marshall-Lerner condition holds, but in the short run it is likely that the trade balance will actually decrease. And there are two ways of thinking about why this will happen. One reason is that if the currency becomes less valuable, the impact on imports is immediate, but the impact on exports will take some time to kick in. That's why initially X minus M actually goes down and eventually it will go up. The other way of looking at this is that the elasticities represented in this relationship are really longer term elasticities. As we saw earlier in microeconomics, elasticities might be different depending on the time frame that we are considering. If we simply take a very short time frame, then elasticities tend to be relatively inelastic and elasticity increases with time. So it is quite likely that the elasticities that we are considering here are over a longer time frame. We now come to the second approach, which is called the absorption approach. This approach is based on macroeconomic principles, and I think the best way of covering this approach is by going over the summary in the curriculum. I will read the summary and explain this to you. In order to move the trade balance towards a surplus, a change in the exchange rate must decrease domestic expenditure. That expenditure is also called absorption. That's where the name comes from. So, must decrease domestic expenditure relative to income. Another way of expressing this is that the change in exchange rate must increase domestic saving relative to domestic investment. This relationship, which I hope you have memorized by now, illustrates the point very well. If there is an increase in savings relative to investment, then X minus M goes up. X minus M goes up means that we move towards a surplus. If we are in a deficit, then the deficit becomes less. If we have a surplus, then the surplus increases. Also notice that G minus T represents government savings. Overall, if savings are up relative to investment, then X minus M goes up. If savings are down relative to investment, then X minus M will come down. If there is excess capacity in the economy, then currency depreciation can increase the output or the income by switching demand toward domestically produced goods and services. Because some of the additional income will be saved, income rises relative to expenditure and the trade balance improves. I hope this is self-evident. Clearly, if the currency decreases in value, then the imports become more expensive, which means that the demand for domestically produced goods goes up, which means that income will go up, and because some of that additional income will be saved, that means that our savings numbers will go up relative to investment and X minus M will go up. This is the situation where there is excess capacity in the economy. What if we do not have excess capacity? If the economy is already at full employment, then currency depreciation must reduce domestic expenditure in order to improve the trade balance. The main mechanism is a wealth effect. A weaker currency reduces the purchasing power of domestic currency denominated assets, and households respond by reducing expenditure and increasing saving. So in other words, people feel less rich. When people feel less rich, then the assumption here is that people save more, and again back to this relationship. If people save more, then X minus M will go up. Let us summarize the main points from this reading now. You need to understand nominal and real exchange rates. The key relationship here is the one that I spent a lot of time on, which is that the real exchange rate, expressed as follows: price currency over base currency is equal to the spot exchange rate, again price over base, multiplied by the price level in the base currency over the price level in the price currency. The price level could be indicated by the CPI. We then talked about direct and indirect exchange rates. If you are a German investor, then for you a direct exchange rate will be one where the US currency is the base currency. Appreciation means that a currency is becoming stronger. Depreciation means that a currency is becoming weaker. If we have the following exchange rate quote, 1.4000 USD for 1 euro, and this number goes up to 1.5, here euro is the base currency. If the exchange rate goes up, this means that the euro or the base currency is becoming stronger and the price currency is becoming weaker. Spot rates are the rates that are in the market today. More specifically, spot rates are generally T+2, which means that the agreement is made today and the transaction is made 2 days later. But for the sake of this reading, we effectively say that spot rates are the rates in effect now. A forward rate is a rate that we agree upon today and the transaction happens at some point in the future. Cross rates are rates that we derive based on two other rates. And going back to a very simple example, if we have the PKR to USD rate, let's say that is 100, and we have INR to USD, let's say that is 60, then the rate that we derive using these two rates is called the cross rate. Currency exchange rate regimes Here we talked about a spectrum of different regimes ranging from fixed to floating, and I would say that you memorize all the points that were in the slides presented. They cover the most important points. And finally, impact of exchange rates on trade and capital flows. Here we talked about an elasticities based approach and the absorption approach. The elasticities based approach says that the impact on the trade balance depends on the elasticity of exports and the elasticity of imports. The greater the elasticity, the more the impact will be of a change in exchange rate. And the absorption approach is based on macroeconomic principles, which says that as long as savings go up relative to investment, then that will have a positive impact on the trade balance. As always, I want you to read the summary, review the learning objectives. In these lectures, I have actually used the examples from the curriculum. I think those examples are very good. Make sure you also do the examples on your own. There are a few MCQs that I skipped. Make sure that you do those very well also. Do all the practice problems, and if you have time, also do practice questions from other sources.